Hello and welcome to the Daily Finance Wrap, your daily dose of personal finance updates covering everything from investments to insurance to real estate and loans. We love to make the show interactive, so please feel free to write me with your question and queries on this YouTube Live. I'm Samina Nalwala, and let's take a look at the top stories of today. Markets continue to recover. The Sensex recovered 901 points, ending at 80,378, while the Nifty rose 270 points to close comfortably about 24,484, driven by broad-based buying. IT stocks led the rally in trade on back of a Trump victory. Other sectors such as real estate, oil and gas joined the party. All eyes now on the Federal Reserve as markets expect another rate cut coming in from the Fed. Among top gainers on the index was Bharat Electronics, Adani Enterprise, TCS, Tech Mahindra, and Infosys. While stocks like SBI Life, Titan, IndusInd Bank, and HDFC continue to see selling pressure. All sectoral indices ended in the green in today's trade. Well, Donald Trump has declared victory in the US presidential elections, and in anticipation of the Trump victory, the Nifty IT index rose more than 3%, becoming the top performing sector. All 10 stocks on the index gained between 1% and 4%, with Infi, TCS, and HCL Tech driving the gains. The IT index has not had a strong run over the last 2 months, with a 2% drop in September and nearly a 4% decline in October. But it reacted positively today after the Republican candidate Donald Trump declared victory in the 2024 US presidential election race against Kamala Harris. Well, the much awaited mega IPO of Swiggy opened today for subscription and will close on the 8th of November. The IPO, which is worth 11,327 crores, becomes the second largest IPO in the history of Indian IPOs. The IPO consists of a fresh issue and an offer for sale. The price band is in the range of 371 to 390 rupees. Ahead of its IPO launch, the unlisted shares traded in the grey market premium with a mere premium of 20 rupees, suggesting low demand for the offering. Experts are divided on the Swiggy IPO, with some believing that it comes in at a deep discount to its listed peer Zomato, while others believe the losses, negative cash flow, and challenges in the company's growth strategy could mean that it's best avoided for now. And there's some good news coming in if you're a taxpayer, which you are. The Income Tax Department has introduced new guidelines allowing tax officials to either reduce or waive the interest that taxpayers owe on delayed payments under certain conditions. According to Section 222A of the Income Tax Act, taxpayers who miss the deadline for paying a tax demand are charged a 1% monthly interest on the overdue amount. However, in certain situations, senior tax officials can now approve a waiver or reduction of this interest if specific conditions are met for interest amounts over rupees 1.5 crores. But what is the eligibility criteria for this relief? The payment of interest must cause or have caused genuine financial difficulty for the taxpayer, and the delay in payment should have been caused by circumstances beyond the taxpayer's control. The taxpayer must have fully cooperated with authorities on any related proceedings. Well, those are the top headlines this Wednesday evening. But joining me now to have a very interesting discussion is Rushabh Desai, founder of Rupee with Rushabh Investment Services. Welcome to the show, Rushabh. Great talking to you on this very historical day for the world. But let's get down to a conversation, an age-old debate. SIPs or lump sum? Should investors, should long-term wealth creators or generators look at investing through the SIP route, or should they look at a lump sum investment? Start by telling us the very basic characteristics of each approach.
Hi, Samina. First of all, thanks so much for having me on the show. I'm very excited to start my journey with the daily finance wrap. I think it's quite interesting that what you guys are doing to educate and touch people's lives financially. So, Samina, to put it very simply, see, SIP means systematic investment plan. It simply means that you are investing in an automatic, disciplined way on a fixed particular date. The money gets debited from your bank account on that specific day. What you have, what you have desired for. It can be either weekly, it can be either monthly, quarterly, semi-annually, or annually. Usually, SIP methodology is done on a monthly basis. For those who maybe don't have cash in hand, or they want to invest in a disciplined way. They don't want to time the markets, and just get the long term average returns over their respective time frames, right? Now, on the other hand, lump sum simply means that you have a certain amount of money in your hand, say like 5 lakhs, 10 lakhs, or probably say 20, 25 lakhs, whatever money you have. You're investing not in a systematic way, but you're investing based on the market conditions. See, if you feel that the markets are correcting, which they are at this point of time, maybe investors may want to invest some lump sum amount of money during this market conditions to enhance returns. SIP basically will give you an average kind of returns, but of course, lump sum does have the capability, if invested at the right price, at the right valuation. I think lump sum could be a game changer in giving you some superior double-digit risk-adjusted return over the longer period of time.
Hey, Rishabh, I picked up a few keywords from what you said, right? Liquidity conditions and market conditions. Now, these are two very important decision making or inputs that will determine what one should do. Is it a fair assumption for me to make if you do not have uh, tight cash flow in that sense, lump sum may be preferred, or an SIP is preferred if a market condition is works in a certain way? So, what I want to get from you is how do you decide which one you do? Is it based on your liquidity conditions or is it based on market conditions?
See, first of all, you need to understand that SIP is a methodology, it's a discipline methodology. See, we are in the business day in and day out. So we look into the markets 24/7. We understand the markets thoroughly, right? But there are a lot of people out there who are doing different jobs in different professions, may not be able to look into the markets on a day-to-day basis, right? So specifically for them, I think SIP is a much more easier route, because it takes away, timing the market. It takes away, that you really don't need to watch the market day in and day out. You let the money be invested on a month on month basis for a certain number of years, and then you look at it, probably say once in a year or once in 6 months or so, see how the portfolio is doing, how it has grown or not. So I think SIP is a very simple fashioned, but more systematic and more disciplined way. But on the other side, say people who have cash in hand today, I think investing at the right valuation and the right price is something very important, because what we have witnessed is that, people who have entered at the wrong valuation and at the wrong price, especially the lump sum amount of money, can take a very long time for them to recover and get the return. See, I'm not saying that investing at high valuations is wrong, but investing at high valuations will not serve the purpose, because you want to invest lump sum money to get higher returns, and the only way to get higher returns is to invest at the right price and the right valuations. On the other hand, SIP basically is investing at all given points of time in the market. Basically, they're investing at high point, they're investing at lower level, they're investing at middle levels in the market. So you're actually just averaging out over the longer period of time.
Yeah, and also so relevant because it's so difficult for one to call it a top or a bottom, right? I mean, while data, history, information could help us identify when the markets are expensive, the fact remains nobody can beat the flow of money. And hence, I think SIP or staggering your investments over a period of time may always be the right thing to do. And a mix of both, I guess, is ideal, which we'll talk about in a minute. But let's talk about market volatility. And it's a classic case of what we are living through right now. We had a big fall in October. November started off with a downtick. Then you had Trump coming into power in the US, and our markets are rejoicing, which clearly means that we are extremely volatile and sensitive to so many moving parts all over the world. In your opinion or in your experience, is one method more effective than the other in managing risk associated with market timing?
See, Samina, both methodology, has its merits actually. Okay. Uh, when you talk about one method, you need to understand both the methods thoroughly, which I just explained, previously. I think, see, I'll keep it again very simple for your investors. If someone has cash in hand at this point of time, right, then of course this is a very good time because markets are in a correction mode. Have markets corrected very deeply? Answer is a no.
Mhm.
See, 10-15% on a year-on-year basis, markets have corrected, which is very normal and very natural. Now, there are two ways to look at this in the markets. One is a price correction and one is valuation correction. Okay. And there are three segments in the markets. One is large cap, one is mid cap, and one is small caps. I'm not going to talk about sectorial and thematic because that's going to be a never ending topic today. So today, as we speak, we are in a price correction. Valuations haven't corrected that much, especially in the mid and small cap space. If you ask me that if I had money today, I would be more comfortable deploying my money in the large cap space because large cap space is more reasonably priced and is the valuations are trading at close to their long-term average. But if you look at the mid and small cap space, even though there has been an 8-9% or probably 10% correction, the valuations still remain very elevated. So there are higher chances of mid and small caps falling further, or there are higher chances that the mid and small caps can stagnate and can give you no returns for a longer period of time. See, we have seen that mid and small caps have given no returns for as long as probably say 7 to 8 years at a stretch. Okay, so it's very important when to look at the margin of safety. See, when we look at SIP, you are averaging. So the margin of safety is much more higher in an SIP methodology than a lump sum. But the margin of safety in lump sum is much more safer when the valuations are reasonable, which I don't see today, especially in the mid and small cap space.
Hmm. Okay, and I guess I'm going to go off script for a minute because what I also want to understand from you is so you have investors who have a regular cash flow, right? So where they'll put some money aside, and you have clients you probably advised this for, where you allocate some amount of money that goes into investing and that becomes part of your long term portfolio. But then there are also situations where you might have a big bonus that comes your way. Then you've got a chunk of money that you need to allocate for your long term portfolio. That lump sum money, then do you recommend gets staggered over a period of time? Or would you also then say that continues to go into equities, either lump sum, and if not lump sum, it goes staggered, and until then it stays in, say, an arbitrage fund? What is ideal? Again, would this be dependent on where the markets are, or is that irrespective of that?
Samina, this is a great question. I really get a lot of clients asking me this kind of question, what to do with the ideal money which I get in, or someone has got a bonus, or someone has sold a property or something like that, or someone has inherited some kind of money or the other. See, whenever someone invests a lump sum amount of money, valuations and price is something one should really closely look at. See, ultimately, bhav bhagwan hai. This is what we say in Gujarati, right? See, if you invest at the wrong price, you may see mutual funds is relatively much more safer, right? But when people invest in stocks, and if they invest at the wrong price, then they can get really screwed for a very long period of time. So I think people who have got some chunk of money either through inheritance, bonus, or some kind of selling of property, parking that money in a liquid fund or an arbitrage fund or an ultra short duration fund makes more sense. And then looking at to the market scenario and the products what they have, and depending on the risk appetite and their asset allocation and their time horizon, slowly and steadily money can be deployed into the equity markets. In equity markets, we always tell our clients that you should be very clear that equity markets are going to be very risky and very volatile, and you need to have a long term time horizon. So if someone has that kind of risk appetite, time horizon, and if their asset allocation is supporting them, I think parking that lump sum money temporarily in a liquid fund, and then based on the current valuations and based on the prices, staggering investments on dips or on valuation corrections is something what we recommend.
Rishabh, that brings me to your to my next question, right? You mentioned asset allocation. Now, for somebody who's starting their journey, say today evening, you have a client who comes to you and says, "Look, I want to start investing in the equity markets." What do you do then? Because his equity allocation at this stage is zero. He is sitting on some idle cash or maybe some investments that are available in fixed deposits or in debt. What would you then tell him? Because I think then the advice would change, right? Because you're literally at zero. And then lump sum or SIP, what do you think?
Samina, see, if someone has zero exposure in equity today and has, say, like 100 rupees, they want to allocate in equities. Now, this is what I would recommend. At this point of time, out of the 100 rupees, I wouldn't put in all in one shot in the pure equity segment. Uh, Different categories and different products based on their risk, because as I mentioned, there are three spaces. One is large cap, mid cap, and small cap. If someone has a long term time horizon and someone can stomach volatility, then 25 rupees can be allocated into the pure equity segment as lump sum today. I would suggest them to start an SIP. Say if someone is earning again 100 rupees annually, on a month-on-month basis. Sorry. So I think an ideal SIP allocation should be 20 to 30%. So around 20 to 30 rupees, I would recommend to start an SIP. But apart from that SIP, if I have 100 rupees as lump sum, then allocating 25 rupees in the equity as lump sum, and then looking at how markets are panning out to be over the next 2-3 months, then I would take a call systematically. But I wouldn't
Mm.
go all in one today.
Even if you're starting your journey of investing in equity today, you would do a combination of both, is what I understand. Now, this is about equity, Rishabh, and we really talk about debt, but it's important because at a portfolio level, there is equity and debt, both asset classes, right? While SIP in some cases may be a preferred route for equity investments because you want to get the cost of averaging or rupee averaging, like they say. What happens in debt? Does the same logic apply in debt? Would you stagger your investments or debt, or would you go lump sum? Because all you're really trying to do is have debt as your cushion, as opposed to the asset class generating the alpha, right?
Sameen, see, there are various categories in the debt segment as well. So now what we spoke about was liquid funds, ultra short duration funds. These are like low duration funds which are meant for temporary kind of parking, right? I mean, of course, you can park the money for longer periods as well, but they are typically meant, ultra short, liquid. They are, going by the words itself, they are meant for kind of like short term parking and kind of temporary parking. But if as you correctly said, that there will be so many clients and investors out there, who want to follow a proper asset allocation between equity, debt, gold, real estate, stuff like that. So I think debt is something what I truly encourage, is something what is very ignored also out there, because we push equities too much. See, debt, especially as a category, has corporate bond funds, they have banking and PSU funds, which are meant to give you higher yields, right? So I think if someone has probably say 2 to 3 year, and see today the rate cut cycle hasn't even started from the RBI side. So this is a very good opportunity for debt kind of investors, for conservative investors who want a little bit of a higher yield from a traditional fixed deposit. I think looking at corporate bond funds, banking PSU funds is something what I would recommend. Coming to your question very precisely, you don't need to really stagger your investments in the debt. You can always invest lump sum money in the debt, because the only segment in debt which I feel is going to be cyclical is the long duration side, which is like 10-year GSEC and other long duration bonds, which has a maturity profile of more than 10 years. But if someone is looking to invest in a medium duration, short to medium duration, anywhere between say 3 to 5 years, then lump sum money can be deployed. But in long duration side, I think when the interest rates are at the peak, I think that is the time lump sum investments can be made. But otherwise, investors can invest lump sum money in the debt at any given point of time, Samina.
So, in the current market conditions, Rishabh, where the equity markets have bounced back, so much has changed in the last 24 hours, right? China has gone into to the doghouse in some ways. IP is rejoicing. The markets have pulled back. Some amount of excitement has returned. That's, of course, on the equity side. We do understand that Trump's measures will be inflationary, which also means the Fed will delay its rate cut after the one that we have soon, which is on the 7th and 8th of November. What happens then to our rate cycle? If we are expecting the RBI to cut rates or not cut rates as early as Feb, would you then allocate a significant chunk of your debt investments to debt in a lump sum way right away?
See, right now, more or less the yield curve is flat, Samina. So I'm very comfortable deploying money depending on one's risk and time horizon, whether it is on the shorter end of the yield curve or the medium space, all at the longer side, the longer duration bonds, right? I feel that RBI should, again, I'm using my words very carefully. I'm not saying RBI will, but RBI really should start the rate cut cycle as early as from December, because we really want to push growth. See, the earnings what are coming out are kind of like flat on a year-on-year basis. 34 out of the 50 Nifty 50 companies have delivered 0% earnings growth on a year-on-year basis. So now growth is something I feel I'm really concerned about it today, and I would not want growth to go off track or derail, right? So once RBI starts the rate cut cycle, more liquidity can be pumped in and growth can go back on track the way it was earlier. Now, once the rate cut cycle actually starts, see, we don't know how deep the rate cuts would be. That is a very big question mark, right? But rate cuts are not going to be as steep as expected. Probably, the rate cut cycle will be little on the conservative side, which the RBI has always been. So probably once the rate cut cycle actually starts, then sticking on to shorter duration funds or shorter duration bonds and medium duration bonds or funds is something what I would recommend. I wouldn't recommend investors to go beyond the 5-year maturity bucket. Sticking somewhere less than 5 years maturity bucket is something what I would recommend.
Right. Rishabh, also, because I've caught you on a very interesting evening and we've seen what IT stocks have done and all these news points and news articles about how Trump is great for the IT sector, right? I'm guessing there'll be a whole lot of retail investors who want to go invest in a thematic fund at this stage. What is your advice to them? And I know this has got nothing to do with SIPs or lump sum, but it would really be good to know what your thoughts are. Would you recommend investing in a tech fund? Or would you recommend buying an IT ETF or third alternative? Maybe just leave it to a flexi-cap fund manager because he'll pick the best bet.
See, I feel thematic bets need to be timed well, Samina. And there are only two products I feel I usually don't recommend thematic and sectorial funds. If someone is investing in the tech space in the US economy, which is NASDAQ 100 or the FANG Plus index, those are brilliant funds and brilliant themes to enter into. But if
would you,
ask,
Rishabh, at this stage, would you enter into them, given the backdrop that Trump is in power and he's great for equity markets? So if somebody
via
doesn't have a
SIP
global
route,
exposure, good idea to do it?
via SIP route, definitely yes. Not lump sum, because today US markets are way expensive, and I'm not comfortable putting in lump sum money today. So via SIP route, 100% yes. Someone should have some kind of small exposure in the US economy, because the economy is so strong, so giant. There are companies, the IT companies like Apple, Microsoft, Tesla, like Nvidia. These are super giant companies with having global present, and the earnings have been super strong. So some exposure in the US economy is definitely needed. Another reason why I feel so is because dollar is so strong. I mean, a lot of people are talking, that dollar may not remain strong enough for a very long time. But let's beat the fact that today dollar is the primary global currency. right? And it is appreciated. It's not that it is not appreciating. So I feel that some kind of exposure via SIP route, either in the Nasdaq 100 or the FANG Plus index, is something what I strongly recommend. Coming back to the domestic picture, I think, see, if someone has, say, 7 to 10 years time horizon, if someone has a high risk appetite, I would recommend, creating a portfolio of, say, probably 50-60% into flexi caps, and the rest can be divided into pure mid and small caps. I think if you create this
Right.
kind of portfolio, the sector rotation and the theme rotation will automatically happen in different market caps, Amina.
Right. Rushabh, one quick question. What are the common mistakes investors make while choosing an SIP or lump sum investment, and how do you avoid these pitfalls? And more importantly, for somebody new to investing, what would your advice be? Apart from them connecting with an advisor, what is the other important advice you would like to give them that they need to keep in mind before they decide their preferred route of investing?
So, Amina, I'll come to the SIP first. See, there are two common mistakes what investors make and what we have observed in our clients' portfolios as well. Is that a lot of investors, they're not disciplined. They stop their SIP somewhere in between, either when the markets kind of like peak out, or markets crash and they touch the bottom. That is the time investors do get little jittery on both the sides respectively, based on their psychology. So I feel, investors are not, see, although we are seeing a good amount of more than 20,000 plus crore of month on month SIP, but if you actually say the net is actually probably half of that, right? This clearly shows that, SIPs are either getting stopped, or the money is getting pulled out in some way or the other. So I feel, maintaining a disciplined approach towards your SIP throughout your time horizon. See, if your time horizon is 10 years, then you really need to stick with the SIP for that entire 10-year time frame, keeping a 1 or 2 year buffer period. Second, another mistake what a lot of people make is that people don't understand that inflation is eating up their pockets. So they really need to step up their SIP based on the inflation also. So, this is what we tell our clients, that, stepping up your SIP in line with your inflation is something what we really recommend them to do, either 5% or 10%, whatever it is. But they don't top up, because the thing is that they don't understand that inflation eats up, their wallets, Amina.
You're right. And we could go on and on about this conversation, Rishabh, but we've got a bunch of questions that I want to quickly ask you. So let's highlight those. Charmi writes in and she says, when choosing for EPF voluntarily, what is best, investing per month or lump sum if it's available at the start of the financial year?
I think both are fine. It depends on your cash flow. If you don't have cash in hand, then of course going on a month-on-month basis makes more sense. If you have immediate cash available, then of course deploying at one go is something what I would recommend.
Okay. Rishabh, Nidhi writes and she says, are there any specific IT companies that might be good for small investors?
That's a great question. Unfortunately, I don't recommend stock-specific things, so I won't be able to, answer stock-specific questions. But I can definitely suggest, going via the mutual fund route. There are some brilliant IT-related funds, and for example, like Parak Parak FlexiCap Fund, they do invest a certain portion of their corpus abroad in the US IT space. So I think venturing into these kind of funds or going into pure thematic or sectorial IT funds should do the job for you.
Rishabh, Everything Everywhere writes in and they ask, how does Swiggy IPO stack up against Zomato? Is there a major difference? Apart from Swiggy being at a deep discount to Zomato and Zomato being 5 to 6 quarters ahead of Swiggy in profitability, do you have any thoughts on what the key differences are and whether Swiggy is a good bet?
Again, Samina, I won't be able to answer stock specific questions. I really apologize for that.
Yeah, no, that's fine. So I have a little sense of this because I've been tracking Swiggy closely, but just to answer that, one big positive for Swiggy is that it's at a huge discount to what Zomato's market cap is. But also keep in mind that Swiggy is 5 to 6 quarters behind Zomato in terms of turning profitable. So you want to keep those two aspects in mind. The growth trajectory is strong. They have cash flow of nearly 10,000 crores post this. fundraise. So that will be an important sort of indicator of what Swiggy actually does with the money and the fact that they're building their quick commerce business. Rushabh, another question from Akash Kotian, and he says, will the US election impact the value of the rupee? Should I be concerned about currency fluctuations?
See, currency fluctuation should only be, let me put it in this way. Currency will fluctuate from time to time. You have to look at the longer picture, the larger picture. Historically, what we have seen is on a 10-year, 15-year, and 20-year basis, US dollar has appreciated anywhere between 3 to 5% on a compounding basis, right? Will this replicate? Maybe yes, maybe not. But at this point of time, dollar is the strongest currency. It's a global currency, and with Trump coming back in action, I truly feel that he may play a very important role in further strengthening the economy and further strengthening the dollar, because he's a true businessman and he is going to think in that fashion of growth. So I truly feel that there are very good chances that the dollar can further strengthen. But of course, there will be pockets where dollar may fall weak and may strengthen as well.
And the rupee currently does trade at a record low as we see it. Charmi has one more question, and she says, can one do a SIP in debt funds? Can I do an SIP in debt funds?
Absolutely, absolutely. Just like equity, you can do an SIP on a month-on-month basis in debt funds. As long as, see, if you have cash in hand, then there is no point of doing an SIP. Just deploy the money. But if you don't have cash, then doing SIP in debt products is a great idea.
Awesome. We've also got one last question from Preetham Das, who writes in, and Preetham says, is there any preference on mode of investment when markets are volatile? SIP or lump sum? I think that's an easy, straight up answer.
I think, see, if I always tell this to my clients, see, if you want to make money, then you have to be aggressive when markets fall. When markets are fearful, you have to be greedy, right? So there is no other way to create wealth. People have not created wealth by investing in a bull market, right? People have actually created wealth by investing in a bear market or a correction market and holding for the medium to long term. So I think if markets are correcting, which they are at this point of time, I think deploying some lump sum amount of money is something what I would recommend.
Completely agree. It is be greedy when everyone else is fearful. I think that's a very famous Warren Buffett line as well. And that's exactly what Rushabh was telling you to do. Grab the opportunity, because this doesn't come often. We haven't got such a significant or started or seen such a significant correction quite some time now. So all that money sitting on the sidelines needs to and should be allocated strategically and intelligently. Rushabh, great talking to you. Thank you very much for your time.
Thank you so much, Amina.
Thank you.